Now, because if the company performs better and better and better and better, the company earns more and more and more profit. If it earns more and more profit, the value that you need to get from the company is also going to keep on increasing out there. So, that is what basically out here. We will deal with this a little more in detail. This, as of now, I am just giving you the basics. Now, having said this, I said that out here I made an interesting statement out there. I said that sourcing money at the lowest possible cost out. So, when I said sourcing money at the lowest possible cost, if it's a debt, you know that there is the cost is lowest because the cost of borrowing is clearly indicated. If it's equity, what is the cost of borrowing? Now, when we talk about equity, we say the cost of borrowing is nothing but expected return by the investors, or expected return of that investment in the market. Now, how do you know, what do you mean by expected return? Do you mean to say 1 million shares bought by 500,000 people? Do you mean to say the company is going to go to each one of the 500,000 person and ask him what is his expected return and then go back and calculate? No. It is basically what happens is the based on the risk profile of that investment out there. Now, every investment has a risk. No, based on this particular risk profile of this investment, I look at an equally risky instrument. I look at an equally risky instrument in the market. I will know what is the kind of return that particular instrument is getting. For example, let us say that this is a very, very safe investment. Now, the risk of this particular buying an equity share of that 1 million shares out there is exactly equal to investing in a fixed deposit in a State Bank of India out there. Now, if I know the risk profile is exactly the same, now what is the expected return of this investment? I will say it is what is the return that State Bank of India FD is giving. It is giving me about 6.5% or whatever it is, or 6% now, etc. Now, I will say the expected return of this investment will be around 6% out there, and when I say expected return is 6%, it is dividends plus what is called as capital appreciation, both put together out there. That is what we talk about, the expected return. That expected return becomes what is called as the cost of equity. That expected return becomes what is called as the cost of equity. I just took a very mundane example of an FD in a State Bank of India, right? That is all. I mean, that is because that is a safer instrument, and I'm just taken that as a proxy. That's all. But in reality, your risk profiles will be different. You take various other proxies and measure. So, when I say raising money at the lowest bar, at the lowest cost, that means what? I will have debt, different kinds of debt, 1, debt 2, debt 3, debt 4, and I will have what is called as equity. All these put together, what do? I take a weighted average. Weighted average capital. I take a weighted average of all these costs, and we normally in finance we call it as WACC, weighted average cost of capital, weighted average cost of capital. So, weighted average we take of all this, debt 1, debt 2, debt 3. What is the weighted average? Very simple numbers. What is the borrowing plus what is the cost? Multiply that. I take the weighted average and I talk about what do you call it as, I arrive at the weighted average cost of capital out there, and normally this is expected to be this has to be managed in such a way that it is normally kept at the minimum out there. That is where you make more profit. Now, why should I look at all this? Because there are aspects when debt in a capital structure increases, equity, cost of equity will also increase. Now, why does this happen, etc.? Just hold it for about 2-3 classes out there. We will come back to all that. So, you have to have some kind of a combination where you keep it at basically what do you call it as a level where your weighted average cost of capital is at the lowest possible level out there. Now, that is the first aspect what we dealt with in this particular aspect out here, that is sourcing money at the lowest cost. Now, I am moving to the next aspect out here, investing money. Investing that money in an option that gives me higher return. And this is very crucial because there is one more aspect that comes in out here, and that is what we talk about in this particular case called as time value of money. That is what we call it as time value. Now, what is this time value of money? Let us take an example out here. Let us take an example. Let us take two possible, what do you call it as, let us take two possible investment options out here. Sorry, I think I made a small mistake. I think they will edit it. Yeah. Let us look at what do you call it as. Let us look at what do you call it as. Let us look at an example out here. Now, what is that example out here? Imagine I have two investment options, option A and option B. Now, there are two parts out here, option A and option B. Now, my investment in both these options, let us say, is about what do you call it as 10, it is about 10 lakhs. Why do I put a minus? Because investment means there is a cash outflow is 10 lakhs. Now, it gives me return over a period of 5 years out there, year 3, year 4, year 5. Now, this gives me, option A gives me, in the first year it gives me only 50,000, second year it gives me 75,000, third year it gives me 1 lakh, fourth year it gives me 8 lakhs, fifth year it gives me another 10 lakhs out there. Whereas, when I look at option B will give me, in the first year it will give me 6 lakhs, in the second year it will give me 5 lakhs, in the third year it will still give me about 4 lakhs out there, in the fourth year also it will give me about 4 lakhs, 8, 19, okay. In the fifth year it will give me just about, let us say, 25,000. Now, which option will you choose, A or B? Basically, I will say if I can total it, in this particular case it is 8, 10 plus 8 is 18 plus 1 19, 19, 75, 19, 75 plus 20 plus 50,000, it is 20 lakhs, what do you call it as, and then 25,000 is what I will get here. It 20 lakhs, am I right with the total, Rishabh? Yeah. Whereas, in the other case I will have 11, 11 plus 4 is 15, 15 plus 4 is 19, 19 lakhs 25,000 is what I will get in the second case. 21 lakh is it? Okay, I am sorry. Let me make that correction. It is 21 lakh 25,000. I am sorry, because I have two of my scholars sitting in front of me. One is Rishabh and another is Mr. Suhail. So, they help me out in the entire preparation of this and then in this teaching process, and they are the TAs for this course. Now, which option would you go? Everybody would say, oh, option A is better because that gives me more money, it gives you more money, it gives you more money. But I would say possibly option B is better. Why? Please note, there is always something that we call it as the time value of money. What is the time value of money? Now, let us say I buy a product. Today I buy a product at 100 rupees out there. Exactly 1 year down the line, that is exactly 1 year from today, I want to buy the same product costs me 110 rupees out there. That means what? The value of the money has basically reduced. there is a 10%, there is the value of the money has reduced, where I have to spend $10 more to purchase the same particular product out there. So that means 100 rupee, 110 rupees what I get 1 year down the line is equal to 100 rupees as of today. I repeat, 110 rupees what I am going to get 1 year down the line is exactly equal to 100 rupees as of today. That is what we talk about when we say time value of money. So in this particular case, the examples out here, imagine you are reducing the value of that money by about 10% out there. Every year the value of the money is reducing by 10% out there. That means the 50,000 you are going to get 1 year down the line, the value of it as of today, because your investment is happening today, you discount it to arrive at the value of today. So I will say, if I have to discount it at 50,000 out there, please do it, 50,000 out here, and then I am going to discount it at what is the amount of discounting, 1 plus 0.1, that is 50,000 divided by 1.1, that is 1 plus 0.1, 0.1 is the interest rate to the power of n, n is nothing but the number of years, in this case the number of years is only basically 1 year out there. So what is the value of it, Suhail? 45454. So the value of this 50,000 what I am going to get 1 year down the line as of today is 45,454 rupees only. The value of this 50,000 what is, that is what I can fetch with 45,454 as of today, I will be able to fetch the same thing by paying 50,000 rupees the next year from today, in the next year, that is 1 year from today. So the value is reducing by 10%. So if I have to do the same thing for 75,000, I am going to do this out here. Let me do it. Let me say I am going to discount it at 10% out there. So year 1 in the case of A and B out there, in the year 1 out here, my discounted value was 45,454. So year 2 I said 75,000 is what I am going to get. So what am I going to do? That is 75,000 divided by 1 plus 0.1 to the power of 2. Why? Because it is to be discounted. First year it reduces by 10%, it reduces further by 10% in the next year out there. So it reduces, what is the value? 61983. You can reduce the decimals out there. Now what happens? Then there is a third year. Third year I get 1 lakh. So I am going to take 1 lakh out there divided by 1 plus 0.1 to the power of 3 in this particular case out there. 75131 out there. Then the fourth year I am going to get 8, and then fifth year I am going to get 10 lakhs, 8 lakhs out there. Fourth year I am going to get 8 lakhs out there. 1 plus 0.1 to the power of 4. 5,46,410 out there. Then fifth year I am getting 10 lakhs out there. 10 lakhs divided by 1 plus 0.1 to the power of 5. 6,20,921 out there. Now let me know what is the total of it. We'll total it later, don't worry about it. Let me go to B. In the case of B, what happens? My first year I am going to get 6 lakhs. 6 lakhs I discounted only for 1 year. So what happens? 6 lakhs out there, discount for 1 year, 0.1 to the power of 1 out there. 6 lakhs I am going to discount it only for 1 year. 54545 is basically what I got. One more 4. 1 more 4. And then what happens? Second year I am going to get about 5 lakhs. Second year I am going to get about 5 lakhs out there. Again, second year I am going to get about 5 lakhs out there. So 1 plus 0.1 to the power of 2.
413,223.
Third year I am going to get 4 lakhs out there.
300,525.
525. Fourth year also I am getting 4 lakhs out there.
273,205.
205, and then the fifth year I am just going to get about 25,000 out there. 25,000 divided by 1 plus 0.1 to the power of 5. 15,523 out there. Now, can I have the total of these two? I think one of you can just do it. For the A, so Rishabh, you do it for A and then you do it for B, Suhail. Which one? 3205, 2,73,205. 2,73,205.
For the A, it's 13,49,899.
13,49,899. For B,
15,47,930.
930. Okay, I am just going to do this. 930. I am just doing this. 205. Yeah, perfect. 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 So if yeah, any problem?
The above total was the totaling was a bit different.
Total is different.
Yeah, they said it should be I think 23 or something.
Which one?
1925.
6 plus 5 is 11. 11 plus 4 is 15. 15 plus 4 is 19. 19, 25. Correct? I am correct. No problem. So now you see that in this particular case, if at the outset, if you looked at, you felt that A was giving me option A, investing in option A was giving me higher return than investing in option B out. But in reality, given the time value of money, I have just worked out this number out here with the help of my TAs out here. We see thus of the value, that is the whatever money I am going to get, the value of that money as of today. In this particular case, you see this, the 6 lakhs what I am going to get, I am going to get the 6 lakhs in the first year. The value of it as of today is value of it of the 6 lakhs 1 year down the line will be far higher than the 8 lakhs what I am going to get out here on the in the fourth year out there. You can see that the value of it. It is, if you will see this, it's marginally, it's almost the same. I'm sorry, it's almost the same. You will see this, it is 5,45,000, whereas it is just 5,46,000, and the difference in amount is 2 lakhs, and the difference in that present value is only about 1,000 rupees out there. So what is happening? You get money at a later stage and a later stage and a later stage. The value of the money keeps on depreciating. So the value of that money as of today is far lower. So if you are getting more and more money at the initial years, then what happens? The amount of discounting, the amount of reduction in value that money is going to see is going to be very less out there. Let us take one more example. I said 100 rupees, I value of 100 rupees out there. Next year I go, I pay 110 rupees and then to buy the same product. 2 years later I go, what will happen? I cannot buy that for 110 rupees. I have to buy it for 120 rupees, the same product. 5 years later I go, I cannot buy the product for 100 or 110 or 120. I will have to spend almost about 180 or 200 rupees to buy the same product out there. So as more and more years pass by, the value of the money keeps on reducing out there. So what happens in this particular case? What do we see? We see that the cash flow from that investment of 10 lakhs, more money is coming at a later stage in the year 4 and year 5. So the value of the money I am getting in year 4 and year 5 as of today is far less. Because why I compare it as of today? Because my investment is being made as of today. Whereas if I look at the case B, I invest the same 10 lakhs, but immediate few years I am going to get more money, whereas at a later stage I am going to get less and less money out there. So what happens? This investment option is higher. Then when I say we are choosing what is called the best possible investment option, or choosing an investment option which gives me the highest possible return, in this particular case when I define the finance out there, what is finance out there, I will have to consider what is called as the time value of money also. I will have to consider the time value of money also, and then look at what is this. Now you said something called a risk appetite. What is this risk appetite? Where is that? Where does this risk appetite come in? I know only one appetite, right? Appetite is when I am hungry. Now, when this particular case, when we talk about risk and risk appetite out there, we will come to that risk and risk appetite as we go along out here in this particular case out there. That is, here I am comparing two investment options, and both the investment options should have the same level of risk, and the level of risk that I can assume out there, that is what is my risk appetite. Somebody can say I have my risk appetite is I am investing in option A or option B. Somebody can say no, why invest in, go in for what do you call it as a betting on cricket or betting on football. Now it is the football season, now go in for betting on football out there. What happens? Your risk becomes higher and higher in that case. Now that I cannot compare with anything else. So do I have the ability to take that risk? Now if I am taking more and more risk, then the cost at which I will borrow will also keep increasing. Please understand the cost with which I will borrow, because imagine I am borrowing money to construct a house. I will get at an interest rate of about 8% or 9% bank will give. I will say I want to go and bet on football, I want to go and bet on horse racing, I am borrowing. Nobody will give me at an interest rate of 8%. Obviously the interest rate is very high, because the risk is very high, because the probability of me losing is very high. If I lose, I may not repay, so the risk is very high, the cost he will charge is very high out there. So that is what happens. The risk also gets camouflaged, or risk also gets driven in this whole thing out there. Now overall, if I have to basically look at what do you call it as summarizing the whole thing. Now we looked at two aspects. One, recording of transactions. Number two, decision making. I talked about product mix, pricing, various kinds of decision to give credit, decision to not give credit, etc. decision making. Now the next aspect when we talk about out here in this particular case, we said sourcing money at lowest cost, investing money at higher return. Now these are the four basic aspects out there. Now these four basic aspects, how do we study these four basic aspects? Now let us first and foremost, let me focus on recording of transactions out there. Let me focus on what do you call it as financial accounting. Let me focus purely on financial accounting. Now what is this financial accounting? Let us sort of look at that. I talk to you. How do I look at the finance? How do I read the recording? Normally what happens? I said we record the transactions, we record in something that is called a journal. Let us not even get into that journal. We will, once you record it, you go through various stages of consolidation of it. That is, you consolidate to a ledger, then etc. out there. When we say we are looking at recorded material, recorded transactions out there, we look at only three basic financial statements out there. In fact, as financial accounting is concerned, the first one is what we call it as the balance sheet. It is, what is a balance sheet? A balance sheet is nothing but, the name might be confusing, it is only a statement of what you own and what you owe out there. These are the only two basic aspects what we look at. What you own and what you owe out there, and that is what recorded. Now what do you own, what do you mean by that, sir? I said first example, the first statement if you had seen, I said that you buy a machinery. When I buy the machinery, who owns the machinery? I own the machinery. Now the statement of balance sheet gives me what I own, the machinery I own, it will be recorded there. Now what do you mean by you owe? I said I buy raw material. I buy raw material on credit. I have to pay that fellow on 25th of December. Now the statement will provide me something that I owe money to that fellow on the 25th of December. Well, that statement, that is what I mean when I owe out there. So the balance sheet will give me a statement of what I own and what I owe, that's all. Now what you own is always called as, they use a beautiful word called as asset. What you owe, they use another word called as liability. They use what is called as liability out there, that is what they use. So what you own and what you owe. Now I move to the next financial statement that we normally use in accounting parlance out there. The next financial statement that we basically use out here is what we call it as the income statement. Income statement is also called as, what do you call it as, some people call it as profit or loss statement, profit and loss statement, P&L statement. It is also called, they will say, revenue and expenditure statement, etc., etc. Now that depends on the nomenclature of the organization out. If it is a for-profit enterprise, it is called as profit and loss statement. If it is a not for-profit enterprise, it is what is called as revenue and expenditure, and so on. Let us not even get into it. All basically the recording information is the same, and this is the second statement out there. Now what do you mean by revenue and expenditure? I hire laborers, they work for me for 1 year, I pay them salary. When I pay them salary, that salary is nothing but an expenditure. I sell goods, I told you, I sell goods, I get money. What is that? That is basically my revenue. Sir, where is profit? When I sell goods, that is my revenue. When I utilize a raw material, that is my expenditure. So revenue minus expenditure is nothing but profit. Did you say when you buy raw material? No, I did not say that. I said when you use raw material. Please note my words. I never said when you buy raw material. When you use raw material, it becomes an expenditure. When you sell the goods, it becomes a sale, and the difference between the two is what we call it as the profit or a loss or whatever you want to call it. Now why should not we take that when we buy raw material? Why should we take only when we use? Don't worry, we will come to that in the next few classes. We will come to that in the next few classes. Or I can even say that when you buy raw material, what happens? You own the raw material, it is there with you, something which you own, you see on the board, that is what is an asset for you. When you utilize that raw material, it is not something which you own, you have utilized it, used it, that is when it becomes, it goes out, it is not something which you own then, so it becomes, gets tagged on as an expenditure in that particular case. Now I will say the third financial statement in this particular case is what we call it as the cash flow statement. Now what is this cash flow statement? Why should it be different from the profit and loss statement? I sell goods, well, I receive money and it's there in the profit and loss account. I purchase goods, I purchase raw material and I use raw material, well, it is there in the P&L statement. Then why do you need a cash statement? Please understand, the income statement, there is one more concept which we use out here. The income statement is always prepared on accrual basis. Now what is this accrual basis out there? Now what is this accrual basis? I said that I sell I said that I purchase goods on December 1st, raw material on December 1st. I pay that fellow $25 down the line on 25th of December. I sell goods on the same day, 30th of December. Sell the whatever I have purchased, I sell it on the same day and I get the money on the sale on 30th of December. I have neither paid cash nor have got cash on my sale. Neither paid cash for the purchase nor have what you call it as got cash on the sale I have made. There are two transactions that has happened. One transaction purchase, second transaction sale that has happened. Now, as far as my profit and loss statement or the income statement on the 1st of December is concerned, have I utilized the raw materials that I have bought on the 1st of December? Yes, I utilized it because why? I have sold it. So, I utilized it. It is an expenditure which is accrued. Have I sold the goods to somebody? Yes, I have sold the goods to somebody. Somebody has bought it from me. That means the ownership of the goods has transferred from me to somebody. Liability is his. That is, he buys the goods and the goods get destroyed in fire. It is his liability, his problem, not my problem, because ownership is transferred. So, what has happened? I have utilized the goods, expenditure has occurred. I have made a sale, income has occurred or revenue has occurred out there. So, what happens in the income statement? I will record that as a revenue as well as record the utilized raw material as an expenditure. So, that is what we call it as it is accrued. Cash has not come, do not worry about cash. So, profit and loss statement or income statement, we are always prepared on what do you call it as an accrual basis. Either income has accrued, expenditure has accrued, yes, it will find a place there. Actual cash not gone in, no problem. Your question might come, what happens if that fellow does not pay me on 30th of December? We will worry about it on 30th of December. If he does not pay, there is a legal course available. Let us worry about all the legal course as we go along. Let us not worry about anything as of now. As of 1st of December, purchase has been made, utilize the goods. Utilize the goods, expenditure. Utilized means I have sold, somebody has bought it from me, so income has accrued for me. So, that is what we call it as accrual basis. So, what does the cash flow statement do? The cash flow statement just records all the cash that comes into the business and the cash that goes out of the business out there. All the cash that comes into the business and the cash that goes out of the business out there. Now, when we talk about accounting, recording, these are the three statements that one has to basically look at out here. I am just going to color it differently. These are the three statements that one is going to basically look at out there. Now, what is the relationship with this and financial forensics out there? Frauds can happen in these three financial statements, the way in which I record, the value at which I sell, the value at which I purchase, all these aspects can basically, frauds can originate in these places out there. So, the first and foremost job for me is to understand these three financial statements. Then let us worry about how fraud can happen in these statements out there. Let us understand these three statements, the balance sheet, the income statement and the cash flow statement. What is this statement? What is the content of this statement? How is this statement prepared? Let us first understand that. Once we understand that, then let us get to the next stage of fraud. The fraud part of it, you will start it only at a later stage out there. The initial part we are going to focus on understanding these financial statements. So, in the next step, what we will do, I have a small exercise which which will be posted out there. It's a small one-page exercise. We will try and solve that one-page exercise to understand the concept of what do you call it as the balance sheet better, followed by another small what do you call it exercise to understand the income statement better, and so on and so forth. Okay. As of now, I close here. Thank you very much. Thank you.